No, I didn't fail math, but by the end of this video, I will have you convinced that 1% is the same as 24%. Do you like to outsource some of your daily tasks, such as cleaning your house, laundry services, or managing your portfolio? I know some of you love to pay for the convenience of managing routine tasks. I love paying for delivery services because I hate shopping. Amazon Prime costs about $12 a month for the convenience of me not having to leave my house. But what if Amazon Prime starts charging me a percentage of the item I buy? Would I still use it? The answer is no, and neither should you. I hope you understand where I'm going with this. If you watched How to Get Rich on Netflix, you must have heard Shetye tell Natalie why he thinks it's a terrible idea to keep her money with a financial advisor charging her 1% of her assets. Over the long run, a 1% convenience fee will cost you 24% of your portfolio. In this video, I will break it down for you to understand and tell you what you can do to protect your portfolio. Hi there, I'm Avanti. I'm a mom, an investment analyst, and a CFA charter holder. Subscribe to my YouTube channel and follow my Facebook page to learn how to build wealth through investing. Let's dive into the actual cost of convenience by looking at a hypothetical account. Let's assume you contribute $22,500 to this account at the beginning of every year. The annual long-term broad stock market returns have averaged about 8% historically. The returns have not been 8% every single year. They could have been above or below 8%, but on average, the annual returns have been about 8%. So that's the number we are going with for this analysis. The first column shows you the years. The second column shows the portfolio value at the beginning of the year. The next column shows the portfolio value at the end of the year before fees. The next column shows the fees you will pay your financial advisor at 1% of the assets, assuming they are paid at the end of the year. Most advisors will charge quarterly or monthly fees, but we assume annual fees for simplicity. The next column shows your portfolio value at the end of the year after fees. We also take that you make a yearly deposit of $22,500 at the beginning of the year. The next column shows the portfolio value if you invested your contributions in a low-cost target date fund with an expense ratio of 8 basis points or 0.08%. The next column shows how much you lose by investing with your advisor versus the low-cost index fund, first as a percentage and then as absolute dollar amount. To understand index funds, watch this video. You started investing today in your account and contributed $22,500. This amount grows at 8% of the year, reaching $24,300. At year end, you will have paid your financial advisor 1% of that value, or $243, making your after-fee portfolio value equal to $24,057 at the end of the year. I did a similar calculation for this column, but with a fee of 0.08%. This value shows the difference between the portfolio values with a fee of 1% versus a low-cost index fund. That makes your total cost equal to 1% for the first year you invested with this financial advisor, which is what you expected. The portfolio value differential is $224. Now let's look at year one. You will contribute an additional $22,500 to your ending balance from year one, making your beginning balance for year one equal to 46,557. If this amount grows at 8%, the ending portfolio value will be 50,282. Deduct the 1% in fees to yield 49,779. Again, the differential between the two portfolio values is 1%. So you may still be comfortable with your financial advisor managing your money. You know exactly the cost of convenience. But this differential increases to 2% or about $1,500 in year 2. It's the same math for all rows. If you want to understand it better, feel free to pause and compute it for yourself. By year 10, the differential has increased to $24,000. The 1% fee the financial advisor charges costs you 6% of the total portfolio value by year 10. At year 20, the differential is about $140,000 or 12% of your potential portfolio. By year 30, you've lost $500,000 or 18% of your portfolio. And by year 40, this advisor has cost you $1.6 million or 24% of your portfolio. In what world is this cost okay? Would you be okay with Amazon charging you 1% of every item that you buy? This cost is justified if your portfolio advisor can deliver above average risk-adjusted returns consistently. Most advisors or fund managers underperform the broad market index in the United States. You are essentially paying your advisor for underperformance, costing you more than you can ever imagine. Most people start working at the age of 25 and they invest on average for 40 years, unless they're training to become a neurosurgeon, in which case you start investing late, but the invested dollar amount is higher than average. Here's how you can protect yourself. Understand how money works. Investing is not hard. You can quickly educate yourself if you put in the time. Since you're watching me, you've already either begun the process of learning or are at an advanced level. If you must hire a financial advisor, get someone you can pay once instead of a fee based on the percentage of assets managed. Think about it this way. When you hire someone to clean your house or water your garden, do you pay them a percentage of your house's value or pay them by the hour? Hire someone for the knowledge and pay them by the hour. Suppose you can find someone who consistently delivers outperformance. Dig deeper into the portfolio. Look for risk-adjusted returns. Ask them about the benchmark. Ask them about what their alpha and beta are. Don't worry if you don't know what alpha and beta are. You want your alpha to be positive when measured over the long term, and you want beta to be close to 1. If you find this video valuable, please share it forward and like this video and subscribe to my channel if you haven't already. All your love keeps me motivated to create great educational content for you. I read every single comment you write, so keep pouring the love. As always, don't forget to be happy, to be kind, and to be your best self. I'll see you in the following video. Bye.